This is not financial advice. I'm recording my thoughts about Lending Club stock. Almost a year ago, I made a YouTube short in which I said Lending Club seems to be a 5x opportunity unless I'm really missing something. At that point of time, the stock price was about $15 and I estimated $75 in 5 years, which made it a 5x. But after that, I thought it's too good to be true, so I didn't dig deep into it. And also the high interest rate environment also discouraged me from looking deep into it. But recently, the stock fell to about $7, so I got interested and I took a position. And currently I own about 150 shares at an average price of about $7.2. And I'm planning to add another 150 shares in the coming future. I'm going to talk about Lending Club's business model, some financials, and then the valuation. While I talk about these, you will get to know the risk as well as the rewards. Therefore, I would recommend all of you to actually watch this entire video and do not skip just to the evaluation. So let's get started. Lending Club stock is trading at about $7.2 with a market cap of about $765 million. And the PE ratio is about 2.88, but PE ratio doesn't matter for a bank. Price to book is a better metric. So let's look at the price to book value. So the price to book value for Lending Club is $10.23, as you can see on my screen at the bottom. In other words, if Lending Club wants to close their business tomorrow, they can go and sell all their assets, get that money and pay off all their liabilities, and they will still have $10 per share left with them. So that $10 will come to the shareholders. So if I buy the stock at $7 today, even if tomorrow they decide to close their business, I will still get $10. So that's about 50% gain instantly, right? And price to book value of 1 is fair for a bank, and Lending Club is trading at 0.7. Now that we established a price to book of 0.7 is cheap, why isn't many people in the Wall Street buying this stock? There's a particular reason for it. The Wall Street is thinking that the assets that Lending Club has, if they sell it, they will not get their full amount because it has some loans in its balance sheet. Earlier, Lending Club used to facilitate loans, so they get a loan borrower and then they sell it to a bank, so they'll get a commission in between. But ever since Lending Club became a bank, they collect deposits and they give their deposited money to the borrowers, so they keep that loan amount on their balance sheets. For example, if Lending Club lent $10,000 to a particular person A, they will put that $10,000 on their balance sheet as an asset because they know they are going to get that money back plus interest. But Wall Street is thinking that that person A is not going to pay back Lending Club because this is in a high interest environment. A lot of people are losing jobs. $10,000 that Lending Club has in its assets, Wall Street is thinking that this person is not paying back, so Lending Club has to write it off and make it zero. Wall Street is expecting that Lending Club's 700 plus FICO score borrowers are going to default on a lot of their loans, and Lending Club has to write off those loans. And once they write off all those loans, the assets minus liabilities may not have $10 per share anymore. It could be less than $5, in which case if you buy the stock at $7, you will only get $5. So that's why the stock is trading cheap. So that's one scenario. But if you think about the other scenario where you assume that all these 700 plus FICO score borrowers who have high paying jobs pay off all those loans, and even if they lose their job, they can find another job which pays similar amount and they will continue to pay Lending Club back. If that happens, Lending Club has nothing to worry about because their price to book is already less than 1, right? And that's one of the cases that I'm counting on, that most of these borrowers, even if they lose their jobs, they will find another job and they'll still pay back Lending Club most of the money that they owe. And that's what we're going to discuss in this video. Now let's look at Lending Club's business model and some financials. Lending Club, as I said before, is a bank that takes deposit from people and then also give out loans to the borrowers. And they have about 4.7 million members, and average income of these people is 100K and average FICO score is about 700, but they also have high debt. In other words, most of these borrowers have high salaries, but they do not live within their means, or the other case is that they have a lot of responsibilities towards their family and then trying to fulfill them, and therefore they have debt. So Lending Club has about $7.2 billion of deposits, and the good news is 86% of these deposits are insured, which means that if something happens to lending club, 86% of their deposits are safe. People are not going to run and withdraw their money because they know that they have FDIC insurance. And what about the uninsured deposits? For that, lending club has a plan. They have $1.6 billion of cash in hand, and that covers 160% of the uninsured deposits. So they're telling the uninsured depositors that don't worry about your investments, we have got you covered. We have enough cash to pay you back if something happens. So that's a good sign. In the recent quarter, they still made a profit and their non-interest income has come down, understandably, because B2B transactions are very tight. Nobody wants to buy loans or transact with loans because we are in a high interest environment and all the banks and institutions are trying to survive. So there will be less transactions between business to business. So that's why their non-interest income is down. But the most important point is they're still making profit. Let's have a quick look at the balance sheet. I only want you to look at one metric. They're charging 13.15% for these high earners when they take a loan, because most of these high earners have a lot of credit card debt for which they have to pay 22% plus interest. So rather than paying the credit card company that 22%, they take loan from lending club at 13% and save that delta. So the risk with this unsecured consumer loans is that there is no security. They have nothing to seize if the borrower defaults. So that's why the interest rate is pretty high. So before we move on to the evaluation, I want to emphasize 3 points. The first one is we have a bank that has a very disciplined management who consistently give profit and do not chase growth. Number 2 is this company has a price to book of 0.7, which is 30% cheaper than its fair value. Number 3 is this bank is increasing its deposits. Most of its deposits are FDIC insured, and for the uninsured deposits, they have enough cash to cover. So they're taking all the precautions to make sure nothing goes wrong until the interest rates come down, after which they can do their normal business. So they're trying to survive in this very tough macroeconomic environment. So now let's move to the valuation. I have 2 cases. As usual, the first case is the base case and the second one is great execution case. In the first case, I'm assuming 15% revenue growth rate. In the previous year, they grew by about 40%, and this is still a small company, so they can grow at a much faster rate, but I'm assuming 15%. And with that, they can make about $2.37 billion of revenue in 2027. If there are no significant delinquencies, the net profit margin can get to 25 to 30%, but I'm only assuming 15% because I'm assuming that there will be some delinquencies and I want to be conservative. With that, they can make about $0.36 billion of net income in 2027. Just a few minutes ago, I mentioned PE ratio is not a good way to value a bank, but for the purpose of this valuation, I'm going to use a multiple of 10. If you look into JP Morgan or Bank of America, they have multiples close to 10, and I want to have the same multiple for lending club. Even though it grows much faster, it has higher risk than Bank of America or JP Morgan, which is why I'm keeping the multiple same at 10. With that, this company would be worth about $3.56 billion in 2027. With respect to outstanding number of shares, they have about 107 million outstanding shares at this moment, but lending club is no stranger to buybacks, and since they are already profitable, they have to do something with that money, right? They do not pay any dividends, so they can either acquire new businesses or buy back shares. I'm counting on them buying back shares because they did that in the past. I'm counting on 2% buyback each year. This company is only worth $700 million, right? 2% is only $14 million. $14 million can get them 2% buyback each year. So don't think that is significant amount. So with that, they will have 97 million outstanding shares, and that gets the stock price to about $37. Currently they're at $7.2, right? That's about 400% gain or 5x your money in 5 years. Now let's move on to the great execution case. I'm going to assume 25% revenue growth for the next 5 years for this company. This might be a little optimistic, but this is a small company with great management. They can pull it off potentially. And if they can grow 25% year on year, they can make about $3.6 billion of revenue. Like I said before, if there are no significant delinquencies, banks can make even 25% to 30% net profit margins. So I'm assuming slightly lesser delinquencies and assuming 20% net profit margin for this company. Remember, Bank of America has 27.5% net profit margin. So 20% isn't a big stretch for banks, okay? So with 20% net profit margin, they can make about $720 million of net income. I'm still going to keep the multiple as 10 because with banks, we cannot assume anything more than 10, okay? With that, the market cap would be at $7.2 billion in 2027. And I'm assuming 3% buyback here because they are profitable and they have to do something with that profit. So I put 3% buyback. Again, it's not too much. 3% is not too much because this is a very small company. They will still have 92 million outstanding shares, and with that, the stock price would be about $78. Currently, they're at 7.2, right? That's about 989% gain in 5 years, almost like a 10x investment. So in the base case, I'm looking at a 5x, and in the great execution case, I'm looking at a 10x. In the worst case, I will lose all of my investment. Let's say all the borrowers will default on this company, and most of those depositors, even though insured, will take their money out of Lending Club and they will go bankrupt, in which case I will have zero. So this is definitely a high risk, high reward play, and I'm not going to put anything more than $2,500 in this stock. And if things go well, I can make from $12,500 to $25,000. And if things do not turn out good, I will lose everything. And I'm prepared for that. So overall, my thoughts are that this is a high risk, high reward play. I think it takes a lot for Lending Club to go bankrupt. And I'm optimistic that I can get a multi-bagger with Lending Club. And therefore, I'm investing cautiously, which is $2,500 max. Thank you so much for watching. Let me know your thoughts in the comments.